Japan's largest company just paid $7.5 billion for natural gas sitting under Texas and Louisiana. Most Americans have no idea this happened. It's not a headline, but it's reshaping who controls American energy and who profits when you turn on the lights. In the next few minutes, I hope you learn who made more money on this deal, how the money actually flows, and what Wall Street analysts think about the price Mitsubishi paid, and why this signals something big about America's energy future. You'll also see how this connects to your electricity bill, your job, and geopolitics. I'm Mark Roach, petroleum engineer, deal maker, 30 years working in oil and gas across every major region. I bought and sold billions in energy assets. This is FutureWise Energy, where we cut through the noise and explain what's really happening in markets that a lot of people just don't understand. On January 16th, Mitsubishi Corporation announced that it's buying Aethon Energy. Aethon operates in the Haynesville Shale. It's one of America's richest natural gas fields spanning northwestern Louisiana and northeastern Texas. The deal structure is $5.2 billion in cash for equity, plus Mitsubishi assumes $2.33 billion in debt that Aethon already owes. The total enterprise value is estimated to be $7.53 billion. This is the largest Japanese investment in American shale gas ever, and here's what Mitsubishi's getting. Aethon produces 2.1 BCF per day of natural gas. We produce around 100 BCF in the US, so that's a little bit over 2%. That's a billion cubic feet, and that number means nothing to you probably, and that's normal. But picture it this way. That's enough gas to power roughly 15 million tons of liquefied natural gas annually. Or in everyday terms, that's enough to supply New York City's electricity for a year. Or heat 1 million American homes through the winter. Aethon owns 380,000 acres and they operate 1,400 miles of their own pipeline infrastructure. They've drilled 200 undeveloped locations they can tap for growth. But here's the real question everybody should ask. Is $7.53 billion a fair price or a bad deal? Wall Street analyzed this. Wood Mackenzie, Goldman Sachs, Bloomberg's valuation team all weighed in. Well, the consensus Mitsubishi got a fair deal, possibly slightly undervalued, and here's the proof. Well, the deal values Aethon at 5.5 times EBITDA. That's earnings before interest, taxes, depreciation, and amortization. For context, the natural gas sector typically trades at 5 to 6.2 times EBITDA. Mitsubishi's right in the middle. So that's fair market pricing, not aggressively overpaying. Better yet, look at the discount from where Aethon started back in November of 2024 when Aethon hired Goldman Sachs to explore options. Sellers were targeting $10 billion. Mitsubishi closed the deal at $7.53 billion. Well, that's $2.5 billion discount, or 24% below initial asking price. Mitsubishi negotiated aggressively and won. For comparison, Tokyo Gas paid about $2.1 billion per BCF per day for similar Haynesville assets in 2023. JERA paid $3 billion per BCF a day in October of 2025. So Mitsubishi paid $3.5 billion per BCF higher, but justified by Aethon's scale, reserves, and integrated midstream infrastructure. So analysts specifically called this fairly valued to slightly undervalued. somebody ran a fancy style valuation framework and concluded at 5 times EBITDA, Aethion's fair value range sits at $7.1 to $8.2 billion. So Mitsubishi landed right in the middle, right in the sweet spot. So no red flags from Wall Street. The market approved. Mitsubishi's stock was flat to up maybe 1.2% on the deal day. Now, Haynesville publicly traded producers popped 3%. And so that's the market saying this pricing's reasonable. The deal makes sense. Now, let's talk to who actually made money. Aethon is controlled by 3 groups. First, Aethon Energy Management. It's run by Albert Huddleston. He's the grandson of H.L. Hunt, one of Texas' most legendary oil tycoons. The Huddleston family just got a multi-billion-dollar windfall. Huddleston retains a buyback they have that right to buy back for 25% of upstream and midstream interest after the close. So he's not fully exiting. He's monetizing while maintaining upside optionality. Well, that's a smart deal architecture, and the family gets paid now and keeps skin in the game for later. The secondary beneficiary is Ontario Teachers' Pension Fund. That's a Canadian pension fund managing retirement savings for teachers across Ontario. They've been in Aethon since earlier funding rounds, and this sale likely returned 2 to 3 times their original capital investment. So teachers' pensions just got a massive boost from American shale gas. Third, Redbird Capital Partners. They're a private equity firm focused on energy. They acquired stakes in Aethon and are now realizing returns. Typically, PE firms target 15 to 20% annual returns. At 5.5 times EBITDA, multiples on a stable cash flowing asset, this deal delivers that return profile. And then there's the banking fees. Goldman Sachs, JP Morgan, Bank of America facilitated this transaction. Investment banks typically take 1 to 1.5% of deal value as advisory fees. So at $7.5 billion, that's $75 to $112 million in fees split amongst these advisory teams, lawyers, and accountants. Those fees go to bankers, partners, professionals who orchestrated this transaction. Now, here's the critical part: Mitsubishi's cash flow mechanics. Mitsubishi's value creation comes from controlling the entire supply chain. Layer 1, production. Aethon pumps gas from wells at production costs of roughly $1.50 to $2 per unit. Layer 2, processing and marketing. Mitsubishi uses Houston-based SEMA Energy, a subsidiary, to handle midstream logistics, basis arbitrage, and marketing. That adds 75 cents to $1 per unit in margin or profit. Layer 3, liquefaction. Haynesville gas flows 170 miles to Cameron LNG in Louisiana, where Mitsubishi holds tolling capacity rights. Liquefaction itself adds $2 to $4 per unit in value as gas transforms into LNG for export. Layer 4, global LNG sales. Mitsubishi sells directly to Japanese partners: Tokyo Gas, Tokyo Electric, JERA. The LNG price premium over domestic gas adds another $1.50 to $2 per unit. So the total value chain margin is potentially $5.75 to $8 per unit captured across production, processing, liquefaction, and export sales. Multiply that across 2.1 BCF per day. That's 766 BCF annually, and you're looking at $1.1 to $1.5 billion in potential annual cash flow from integrated margin capture. Mitsubishi's financial projections say Aethon will generate 270 to 300 billion yen. That's roughly $1.85 to $2 or $1.85 to $2.05 billion in operating cash flow annually by fiscal 2027. That implies a realized price of $2.41 to $2.67 per unit across all value chain steps. Annual EBITDA is roughly 200 billion yen. That's about $137 billion. That's a 75% EBITDA margin, exceptionally high for the industry. Consolidated net income contribution is 70 to 80 billion yen annually, roughly 480 to 550 million dollars in US after depreciation, financing, and taxes. So here's the return metric. $5.2 billion in equity investment divided by $1.37 billion in annual free cash flow equals 3.8 years to pay back on equity alone. For an institutional investor, that's solid. Add leverage, Mitsubishi is carrying $2.33 billion in debt at an estimated 3 to 4% interest rate. Leveraged returns? Well, estimated 35 to 40% internal rate of return. That's institutional grade returns. And over 5 years, Mitsubishi projects cumulative operating cash flow at 1.45 to 1.65 trillion yen, roughly 9.9 to 11.3 billion dollars US. After CapEx for growth, drilling, and sustaining operations, plus interest and taxes, cumulative free cash flow reaches 4.5 to 5.5 billion US dollars. Add residual asset value of producing profitable gas fields worth $6 to $8 billion standalone in 2030 to exit. Well, total returns are roughly 2 to 2.6 times money multiplied over 5 years. And that's a competitive institutional return. But, and this is important, there's the growth optionality. Aethon has 200 undeveloped drilling locations in a proven formation. Production can ramp from 2.1 BCF a day to 2.6 BCF per day by 2028. That's 500 million cubic feet additional daily capacity, 24% growth. Growth CapEx is required, roughly $1.6 to $2.4 billion spread over 3 years. But that growth generates an additional $450 to $500 million in annual operating cash flow. Payback on growth CapEx, 3.2 to 5.3 years. Incremental internal rate of return on growth dollars, 25 to 30% unlevered. The translation here is Mitsubishi doesn't just get stable base case returns. They get growth optionality that amplifies returns if they execute drilling efficiently. Now let's address the Trump administration angle. This deal doesn't close without political context. In October 2025, Trump and Japanese Prime Minister Sanae Takahashi signed a $550 billion investment agreement. Japan commits to investing $500 billion in American manufacturing, data centers, and energy infrastructure. In exchange, the Trump administration granted Japan a special 15% flat tariff rate, significantly lower than standard U.S. tariffs. It's a trade-off. Trump gets foreign capital flowing into America, jobs in manufacturing heartland, energy exports to a crucial ally, Japan gets energy security and preferential trade treatment. The Mitsubishi deal is Japan making good on that commitment. It's earnest money. Japan says, we're serious about this partnership. We're betting $7.5 billion on American shale. For Trump's team, it's a political vindication. Foreign investment, high-wage jobs in Texas and Louisiana, American energy exports, all the prioritized narrative points. But here's what analysts notice. Japanese companies control roughly 33% of Haynesville production after the deal closes. Mitsubishi alone operates 2.1 BCF per day. JERA operates another half BCF. Tokyo Gas has smaller stakes, and other Japanese conglomerates hold additional positions. So what's the implication? Japan is systematically securing long-term U.S. gas supply by owning direct stakes in production assets, then shipping gas back to Japan as LNG. Well, that's supply chain control. It transforms Japan from a spot buyer of LNG into a direct producer-exporter with margin capture at multiple points. Wood Mackenzie flagged this explicitly. International buyers, they say, find value in U.S. gas assets at current multiples. The combination of soaring power demand from data centers for AI and a surge in new LNG export facilities has led Wood Mackenzie to forecast rising U.S. gas prices over the long term. Translation: Japanese conglomerates see structural demand tailwinds for 20+ years. They're not speculating, they're making long-term strategic bets. Now, the real question: what does this mean for you? Your electricity bill. Short-term, minimal impact. Long-term, more stable, possibly cheaper. Aethion's gas feeds power plants that generate electricity. More domestic production means more competition for Henry Hub prices. Henry Hub is the benchmark for U.S. natural gas. So when there's more supply, prices typically fall or stabilize. Lower natural gas prices mean utilities spend less to generate power. That can translate into lower electricity bills if they pass it on to you. Not guaranteed. Transmission cost, other factors do matter. But the direction does favor consumers. Employment. Well, this is the big one. The Haynesville Shale region already employs thousands directly. Drilling crews, engineers, pipeline operators, truck drivers, add indirect jobs, restaurants, hardware stores, hotels servicing the workforce. It's a regional economic engine. Mitsubishi's acquisition means investment and stability for the next 25 years. They didn't buy into this to flip it in 2 years. They bought it because they expected a sustained production profit. Production is expected to increase from 2.1 to 2.6 BCF per day by 2028. That's a 24% growth. More gas means more drilling, more employment, more infrastructure investment. Texas and Louisiana workers just got a quarter-century employment guarantee from a Fortune 500 Japanese conglomerate. For the Haynesville region, economically, more wells drilled means more work for service contractors, equipment vendors, logistics companies. Tax revenue to Louisiana and Texas increases. Schools get better funding, infrastructure improves. Cameron LNG, the liquefaction facility where Mitsubishi plans to process this gas, already employs hundreds directly and thousands indirectly. Mitsubishi's gas will help fill Cameron's underutilized capacity and justify future expansion. That means construction jobs and permanent positions. For rural Texas and Louisiana, this deal is transformational. Energy infrastructure is often their primary economic driver. Broader context, natural gas is transitioning from a commodity with volatile spot prices to a long-term infrastructure play. Mitsubishi isn't buying into this trade gas and on pocket spreads. I mean, they're buying into it to control the supply chain from wellhead to customer. When Japan bets $7.5 billion, other investors do notice. It validates the investment thesis. So natural gas will remain profitable, essentially for 25 plus years. And that brings more capital, sustains jobs, stabilizes regional economies. The valuation metrics, well, they tell a story. 5.5 times EBITDA on a quality producing asset with 35 plus years in reserve life, a 3.8 year payback on equity, 35 to 45 to 40% levered internal rate of return. Well, these are the metrics that attract institutional capital. So when Mitsubishi, a century-old diversified Japanese conglomerate, signs off on this deal finally, it signals confidence to other investors and more capital flows. More infrastructure gets built, more jobs get created. Here's what the analysts emphasize. Mitsubishi paid a premium price, $3.59 billion per BCF per day. But that premium reflects strategic value, not overpayment. The integrated midstream infrastructure is worth $100 to $200 million standalone. The LNG export proximity is another strategic premium. The certainty of 35 plus year reserves reduces risk. No competing bids were reported, which means Mitsubishi had leverage in negotiations and still closed at a fair market value. The real story isn't whether Mitsubishi overpaid. It's what this deal reveals about global energy strategy. Japan needs American gas. America needs Japanese capital. Both countries benefit from the exchange. Energy isn't geopolitically neutral. It's one of the most consequential strategic assets. When you see $7.5 billion flowing from Tokyo to Texas, you're watching geopolitics in real time. So here's the one-liner takeaway. Mitsubishi negotiated a fair but disciplined deal at realistic market rates for a strategically premium Haynesville asset, achieving significant discount from earlier price expectations while capturing growth optionality that could deliver more than 2 times money multiples in a return over the next 5 years. For you as a viewer, your lights stay on, your job is stable, your electricity costs don't spike. And that's because capital keeps flowing into American energy infrastructure. When Japanese mega caps write a $7.5 billion check, well, it signals something simple. It signals natural gas will power the global economy for decades, and America has abundant natural gas. That's leverage. That's geopolitical advantage. That's why this deal matters. I'm Mark Roach. This is FutureWise Energy. We track the signals that matter.